Hi, folks. This is Sean Hyman from the Logical Investor newsletter, and these will always come out on Thursdays. This one's a little later on Thursday because I was celebrating my youngest son's 22nd birthday today, and so I was wishing him happy birthday and celebrating with him. He'll have his official party on Saturday, but we were uh, doing a little bit of a get together with my men's Bible study group. It meets on Thursday nights with him tonight, and he's a part of that as well. So anyway, this is coming out a little later than typical, but just know they'll always come out on Thursdays. Um, so a couple things I wanted to make sure you were aware of. One, as of a day or two ago, the Logical Investor newsletter, February 2019, came out. So those are out by the end of the month, and in this case, I had them out a couple of days earlier than typical. So you can click on that and see what all I talk about there. I go into quite a bit of detail on Kraft Heinz and spend quite a bit of time on it. So you'll want to check that out. I would also, and of course, by the time I post this video, this will actually be over here on the right-hand column because the video that I produce will be right here. And I would encourage you, if you're new, to first start off by watching these videos and going through the site on your computer, and then later on you can go to a smartphone and navigate through the site and figure it out once you really get the context of where everything's at, from looking at something in a full-fledged browser and on your computer. And two other things I would point out is, if you're new to us, the Ask Sean tab has all kinds of foundational videos, like how to set up your charts, how to work our search engine that we have on the site, getting started video, um, concepts about averaging down, the thinking that basically, where people get wrong in the stock market. This is where I did a live seminar in a church on the 6 Keys to Financial Success, which is my book that's based off of what the Bible has to say about your money. The fundamentals that matter and why, and why they give us confidence. So if you hear me talk about metrics like PE and price to book or EBITDA or stuff like that, you wonder what the heck all that stuff is and why it matters, you can click on that right there. Why momentum trading is so dangerous, which is, that's what most people out there do, whether they realize it or not. The technical indicators explained. So when you hear me mention RSI, MACD, moving averages, all that kind of stuff, I go through those indicators, what they are and what they tell us. And then I also talk about how the successful investor thinks, which the way you think about investing will have more to do with your success or failure than just about anything. So that is more important than you think. And then also I've got a video on Elliott waves right here. So if you see the 1, 2, 3, 4, 5 ABC stuff that I write on there, those tell us basically in a nutshell where we are in the phase of each uptrend or downtrend, and also what the market is collectively thinking. In other words, what the market participants are collectively thinking within each of those phases. So it's a very, very useful tool. It is advanced technical analysis that I try to break down into more plain English. So, and then the last thing I would point out on the site is in the fundamental news and charts section, is a new article that I did on options. So how to succeed in options trading where others have failed. So I realize that everybody that's hearing this will not necessarily be interested in options, but if you are, I talk about the different in each of these bullet points, the different things where people get it wrong and screw up in option trading, and how to fix those screw ups or how to avoid those screw ups. So it's in a very easy to see format, and that's a free article that anybody, even non-subscribers, can benefit from. So I would encourage you to click the Facebook or Twitter icons and share those. You can go to the top of the page and copy the link and email it to people. You can Facebook message it to people. So you can spread this stuff around to anybody that you think may be interested in options, or any other free article you see on our site, which anything is free and open for anybody to be able to access, except for the premium newsletters tab. That is what is subscriber based only. And so that's where you'll find the monthly newsletters, which come out at the end of each month, and the weekly videos, which come out sometime on Thursdays. Okay, so with all of that said, let's get to the markets. The S&P 500 overall is still what I believe is in a bear market. Unless the market proves or tells me otherwise. In other words, if the market went to a higher high, then we would have to say that we're still in a wave 5 of this uptrend. But I don't believe that will happen because we've already spent so much time below the 50-week moving average, which is already now curling lower. So in other words, the market has put forth a lower low, and then we're seeing if it puts forth a lower high. So as long as there's a this high that comes up here is below this top, then you have a lower high, and a lower low and a lower high is the first main thing that denotes a trend change, because the bears were in control of the lows and the bears were in control of the highs, the sellers and the short sellers. So so that's something that I'm looking at there. The other thing is that if you look at this most aggressive uptrend line of wave 5, so you've got waves 1, 2, 3, 4, 5, and an Elliott wave, there's 5 major waves in an uptrend, and then there's an ABC downtrend. And so this looks to have completed 5 waves within its 5th wave, 1, 2, 3, 4, and 5. The latter part of the 5th wave was very volatile, very distant from its 200-week moving average, a lot of characteristics that are very common with the ends of wave 5. So there's a lot of reasons why I believe that this probably is that. And so this is probably a wave A, a wave B, and then coming down into something that's it could be something that stops like at 1900, or it's something that could drop down to 1400. I mean, we've had bear market corrections that have done the likes of these. If you look at them on a percentage basis, the drops in 2000 and 2008, and projected those out into something like where we're off of our highs here, you could get to lows that were anywhere in this 1400 and 1900 box. And it doesn't mean it has to go to these areas, but it means it's likely to go to somewhere within these areas. It also doesn't mean that it has to stop at these areas. I mean, it could, there's anything's possible with the markets. I mean, if you get the fear big enough, deep enough, or long enough, you could have something even more steep. But this would be the most likely scenario, anywhere as much as probably 1900, or as little as 1900, and as much as 1400 minimally. And that also coincides with some basic support regions that were out here and over in here as well, to boot. But we've still got the RSI is so far still putting in lower highs on the weekly. The MACD is continues to put in lower highs. The big sell spikes are institutions selling, because that's not mom and pop selling towards the tops of uptrends. They can't get enough of stocks towards the top of uptrends, and they think the uptrend will never end. So these big spikes aren't them. And also, it wouldn't be moms and pops that are putting up almost 20 billion shares net sold in a week in these 2 occasions. So that's another reason why we know that's not just moms and pops there. So it's institutions. So again, bearish markets. So here's looking at the daily, and you've got this also looks like a bear market bounce, because trending waves in 5 waves up tend to be more clear, and bear market bounce waves, which are bounces up within an overall bear market downtrend, tend to be not quite as clear, and they also tend to be more sharp and V-shaped, because you tend to get more short covering, stronger rallies, which could be perceived as bullishness, like as if they're genuine buys, but they're not. There's just simply people who shorted the market in mass, meaning savvy institutions. And when the S&P goes from 2940 to 2346, of course, there are people that take profit on that. And so as they take profit on that, you close out a short with a buy. So just like you close out a buy with a sell, you close out when you open and initiate by selling in hopes that it drops, you close that out by a buy. So you have enough shorting that comes, that happens. And when people start getting out of it in a similar time frame, it produces a lot of short covering, which is short buying, buying to cover a short, and it produces these moves like this, which can be very V-shaped and so forth. So, again, very bearish here. Believe this is possibly coming to a tipping point. We do have the RSI that has been extended for a couple of months. That's been overbought, and it looks to potentially be coming out of that now. We've got a MACD that's been slumping over for a while, and the histogram has been dying off for a bit, and we finally got the MACD sell signal, which is bearish. We have got, if you connect the lows there, we are right on the line of one of those lows. So any time now that could break and head lower. It doesn't mean it has to head immediately lower. I mean, it could head higher before it heads lower. It could immediately head lower. Its initial targeted area would be somewhere around its 50-day moving average. But those, they'll probably overshoot that a bit. But I would look for it to do something like that. But probably have some kind of weak bounce and then head on lower. But I'm looking for one of the down legs to be very steep, retest the old lows and likely go much lower. So I'm looking for a very bearish move here. And again, we can't tell exactly when the top of this will be. This is so long in the tooth here over these couple of months that we're likely near that. And this move, which was so sharp, is starting to lose a bit of its momentum, meaning that the angle on this thing up to here was like this, but then then it starts to be a little more like this. So the steepness of the angle is starting to arc over some, and that's telling you that some of this upward momentum is likely starting to get closer to its end. So I'm looking for this to arc over, just like we're seeing on RSI and MACD and the dying off of the MACD histogram, and I'm looking for this to go back into its next down leg fairly soon. What is soon? We don't know. I mean, is that days? It's probably likely, but could it be weeks? It could be. Is it months? Not likely. So we're probably looking at days to weeks for this to and who knows? I mean, the very next session it could start trading lower. I'm not saying that it couldn't, but I'm meaning I'm trying to give you a little bit of a timetable there. So I'm very bearish on the S&P, and I'm looking for that next down leg to start fairly soon. Okay, so that kind of provided a little color for the overall market. Let's look at some of our positions. Of course, with gold putting in with the overall market putting in a death cross on its moving averages, and with lower lows and particularly a lower high, we're getting the opposite of that on gold. We're getting a golden cross, which is where the 50-day cross is above the 200-day moving average, and we're getting higher highs and higher lows on it. And so this has made a nice turnaround, but keep in mind the price has gotten very far away from both of its moving averages, so it's only normal for that to pull back some. So the question is, how much does it pull back? Does it because any of this would be normal. It could stop right where it's at and take back off. It could go back to around the 50-day moving average or a little lower and take back off, or it could come back closer to its 200-day moving average and head back higher. And any of that is typical. But the important thing is that the uptrend is continuing. This, trends are called trends for a reason because they last a while, and this one just got good started. So, trends tend to last for many times for years, and so it would be nothing to think that this would trend higher for minimally for months longer, if not a year or two longer, but for sure at least months longer. And so this has got quite a bit more upside to it. Also, you've had the RSI has been heading higher. The MACD has been heading higher. You can probably look at something like that, or you could draw it like this. But either way, all these lows have been getting higher. The selling volume has continued to drop off, which is good. The buy spikes keep prevailing. So lots of good signs for gold. It's a great environment for gold. I mean, you got trade wars, you got Kim Jong-un, you got stuff creeping up with France, riots and protests, stuff happening with, Russia threatening us. You got, we're approaching further debt ceilings. I mean, the list goes on and on and on. You got Brexit, there's like a grocery list of unknowns. And not that we don't live in a world where you usually have one or two of those going on, but when you can build out a whole grocery list of types of things like that, it's a great environment for gold. And then when you consider that the dollar's overvalued and the stock market's overvalued and the stock market is likely starting a bear market, you combine all that and commodities firming up as well. All that's just a recipe for a bullish case scenario for gold. And so that's good for gold. That's good for gold stocks. So if you formerly owned ABX, which is now GOLD, as it merged with Randgold, if you owned Newmont Mining, and again, these are not new recommendations, so I'm not suggesting anybody get into these today, but if you still own them, they're solid. Our current holdings of GLD, GDX are solid, and I expect these moves to last quite a bit longer. So then we've got CHL. So CHL, it's important to go back to the weekly chart on this one. By the way, when you first start analyzing any chart, always start with a weekly chart. Get that 30,000 foot weekly 10-year look back, and you can get that with free charts. You don't have to pay for stockcharts.com. You can get that on their free version. And when you click on that video, how to set up your charts in the Ask Sean section, I show you how to do that. But So CHL has been trending up for years. It had, whoops, let me grab the little annotation here. So, but it had broken its latest, correction. So, in other words, it's in an overall uptrend, but it breaks these corrective moves within here, and then continues these moves higher. So, and there's minor ones, like the one here and the one here, and then there's major ones, which are this one here. And so this major correction lower has been set in. It's above its 50. It's above its 200-week moving average. And we're in the next overall push higher. The point of maximum pessimism was right in here. And then it was followed in early 2019 with big buying volume. The MACD overall has broken its down cycle and is heading higher again. You've got the RSI heading higher again, but it is a bit overbought lately. So I'm ultimately looking for this to come to the 55, 56 area and us sell out. And the only question is will it hang out and build enough base here to spike up to that area for us so that we can get out sooner? Or if it pulls back to one of these two moving averages, the 50 or the 200 week, and then make it on the next run. The second scenario would take a little longer in time, obviously, and ideally, if it would just hold at a high level, build a short base there, and spike up those extra, $2 or $3 per share or whatever, then we would be set and cash out. So. But those are the scenarios that I see that are most likely to happen. So again, very bullish on CHL. You can see how far it is away from its major moving averages, even on the daily chart. So so it wouldn't be unreasonable for it to have a pullback. But does it have to pull back? No, I mean it doesn't. I mean it can spend a good bit of time away from its moving averages without pulling back. But at some point, saner heads prevail and selling kicks in and it takes it back towards its moving averages. So I am saying, the more time it does spend away from these, particularly the 50-week moving average, which the price tends to stay closer to the 50-week even than to the 200-week, and it's very far away from that moving average right now. So it wouldn't be anything for it to to have a very good size percentage pullback before heading higher. That's why I would love for it to just go ahead and spike up those extra $2 or $3 and let us cash out. But this is a very solid stock fundamentally, so I don't have any problem with holding it, for us to still obtain that, even if it takes that secondary longer route. And then next we've got FXB. The British pound has been gaining here recently. There's still, of course, negativity in the market. There's still fear in the market. There's still uncertainty in the market. But one thing you have to realize about markets is stocks don't start turning around when the news all of a sudden turns from negative to positive. Stocks and currencies and any other asset, there comes a point where they start firming up even when the news is still bad. And if you make the novice mistake of waiting for the news to go from bad to good for the British pound or whatever's happening over in Britain, to over in the UK, for you to be in something, then you're always gonna be behind the 8 ball. So this has already had its ABC downtrend, which, since this low is higher than this low, I believe this to be the C wave low. And also you had your point of maximum pessimism here at C, and also at the wave 2 pullback. So C 1, 2, and then we're likely going into wave 3 now. So out of wave 2, here was the latter stages of wave 2, and the buying pressure is building. So I'm not saying there won't be some decent sized percentage pullbacks along the way, because this can have decent pullbacks even closer towards this uptrending line. But overall, I'm looking for this to go into making higher highs that are much higher than these wave 1 highs. And so as that unfolds, we will do quite well. And I believe those who were going to sell, who were the naysayers, who were the emotional investors, I believe they got out here and here. That's the thing about charts, is that you can see what they're doing, not just what people are saying. So, and the greatest points of maximum pessimism are near the ends of wave C, which is the bottom of the downtrend, and near the ends of wave 2, which people think is going to go into the next wave of the downtrend. And so that's why that they're bearish there, because they don't know it's the first pullback within the new uptrend. And even my own subscribers, when I get the questions from you that, oh man, I've been holding this stock for a while, and I'm starting to doubt it, and maybe I should sell out, or I did sell out, or whatever, and all that kind of stuff. And when you have me look at that stock, almost without ever looking at that stock, I can almost bet money that when I go to look at that stock or ETF, that it will be either in a wave C or a wave 2. That's how powerful Elliott waves are, is you have become the embodiment of the sentiment that's prevalent in those waves. So as you mature in your investing thinking, you're actually going to be contrarian to that, and you'll actually get excited rather than fearful about when you're getting towards the ends of wave C's and the pessimism and the news is so horrible, and when when wave 2 pulls back and the selling pressure is great and the news media coverage is still horrendous, you will actually get excited about it rather than fearful and second guessing about it. So some of you are starting to get there, and some of you still are going to need a lot of hand holding and reassurance till you get to that day. But that's what I'm here for. So and that's what many of you in the community are there for as well. So if you are there on some of those times, be those voices of reason and encouragement to the others, and everybody feel free to help each other out. So, as you know, I can't be there 24/7, even though I'm on the site probably more hours than I should be. But there's some of you that are early birds, some of you are night owls, and everything in between. And so between us all, and also there's some of you that are geographically in other parts of the world. So between us all, there's many times where some of us are on the site most of a 24-hour day, on a collective basis. And as we help each other out, there's a lot of questions that we can answer and encouragement we can give to people pretty much around the clock with the format of this site and the way it is. So FXB, again, I'm very bullish on. Again, if you are, watching the news and you're taking your cue from the news, which is what most investors do, which is the dumbest thing in the world, but it's still what most investors do, then you're going to be uncertain. If you're looking for those confirmations, those security blankets, for other analysts to hold your opinion, for TV coverage and news coverage to back up your opinion, if you're looking for any of those assurances, you're not going to find them. And if you had a mass opinion that thought like we did, then you would have most people getting wealthy over time. And it's a smaller percentage of people that get wealthy over time. And why is it? Is it because they can't get wealthy over time? No, 100% of people could get wealthy over time, but it is their thinking and how they rule their own. The Bible talks about how you rule your own spirit well. In other words, how are you controlling your own being? How are you controlling your emotions? How are you controlling your self-talk to yourself? How are you controlling whether you are being reasonable and logical or if you're being emotional? That is all within our control. We know that from a biblical perspective. We know it from just as you mature as an investor perspective. And so be a helping hand to each other on the site. Which, by the way, I'm about to probably put out another options report pretty soon for those who are interested. So if you have interest in that, be on the lookout. I'll teach another concept which I haven't taught before, and which I believe will give you another edge in your options trading and be very strategic. Pretty much no matter what type of strategy you're trying to trade, whether it's buying or selling strategies. And also I may start giving some exact option recommendations within those, how to enter them, how to exit them, etc., all wrapped up within that one report. So I won't mention a lot of that on this video because, again, this is an investing service, not a trading service. Well, what you'll find is the way that I teach you to do options is not near as risky and speculative as you probably have thought or probably have been taught about it. In fact, there's ways that you can utilize options to where you actually have less risk and exposure in the market than you even have with stocks. So, and in some of my reports that some of you already have read, you've already detailed that, and you already see where I'm coming from on that. So anyway, so EWW, this one had a B, and this looked like originally that this was C here, but since this went down to a lower low here, this is actually C here because this put in a lower low here than here. 37's here and 39's here with a spike low and reversal here. So this is probably your lowest low. Here was your point of maximum pessimism right here. Let me get my drawing tool on here. And so that was right here, which would correspond to around there on the chart. And then the selling volume has been dropping off ever since. Your next biggest point of maximum pessimism was right there, which corresponds with what is likely, the actual low or thereabouts. So while it's not conclusive that we've hit our ultimate low here, I would expect any pullbacks to probably be shallower and not hit a new low and head on up to something much higher. As soon as it breaks this downward corrective move right here, which would be around here on the chart, then we'll be confirmed into the next up move, which will also be above both the 50 and 200 week moving averages. So again, I'm very bullish on this one. I believe your ABC downtrend has likely worked its way through to its end. Again, it is too early to confirm that, but the way we know that there is extreme pessimism in the markets right here and right here. I mean, over the last decade, you haven't seen anywhere close to this type of selling here and here. So that tells you that investors in these last couple of years have been more emotional than in the last decade. And anytime you're more emotional, you're more irrational. And anytime you're more irrational, you tend to make stupid decisions. don't believe it, get in a fight with your spouse and listen to all the stupid stuff you say that you don't mean and you regret and you wish you could take back later. And why was that? Because you went from being a logical person having a discussion to emotional, and you just lose all control. So when there is this much emotion, this much negative sentiment, it is denoting the latter stages of a downtrend. Extreme emotion, extreme pessimism tends to denote a bottoming period in a stock or ETF. So this area right in here is probably a bottoming period given this type of negative sentiment. That's why I love volume analysis so much, because it helps confirm how negative and how bad people are getting on something. And again, if the asset is crap, if it's fundamental crap, then of course you could the sell spikes would be justifiable and something would be on its way to zero. But if there's fundamental clout to something where the holdings are in the ETF are good stocks and they're at a low collective PE, which is what you've got here, then it's not going to zero. The downtrend will end and it will turn around and head back up. And so you're just trying to find times that are great to start investing in, and times when the asset is still sound yet at a cheap PE is when you start your value investing in. You divide your order up into threes with them spread wide apart, which again I suggest averaging down points within the newsletters, and that's in the portfolio section, an averaging down column, so that that's not left to guesswork. But also, when the volume and sentiment gets so unusually bad, in other words, when your average volume is somewhere in here, so it's not odd for this to do 15 or 20 million shares net bought or sold in a week. But when this goes up to selling 70 million shares net sold in a week, and over here, 40 or more shares net sold in a week, double or triple or quadruple or whatever typical average weekly selling volume, then you know that the pessimism you're dealing with is on a whole nother level. That's very extreme. And investors, when they are the most emotional and the most fearful, tend to be misjudging the value of a company, and there tends to be the most discrepancy of what the price is and what the value is. And so it's when people are usually most off on an asset, and it's when there is the most value to be had in an asset. And so it's why we like to average down when the solid asset gets to be a fundamental discount, which is shown up in the PE levels. And then we average down along the way with big percentage gaps to where our average price is even brought lower. So the downtrend and the downside volatility becomes our friend, not our enemy. Allows us to get lower PEs, lower prices, higher dividend yields in many cases when there's stocks or ETFs with dividend yields, and buying closer to whatever the bottom would be, and buying when everybody's heading for the exits, we won't be headed for the entrance on fundamentally solid assets. Now again, if it was fundamental crap, then everybody should be headed for the exits and nobody headed for the entrance, but we don't buy fundamental crap. You would be surprised how many people do suggest fundamental crap. It happens on I see it on CNBC's Fast Money. I see it on Jim Cramer's show. I see it on very, very popular, widely watched people suggest and recommend fundamental crap. And sometimes it's because they're trading it, and then they think that they'll be in it for weeks or months or whatever, and so it's going to be okay to be in fundamental crap. But I just like to start with a baseline of we don't invest in fundamental crap. And I just think it's a waste of time. It's needless speculation. It's needless risk of mining your dollars and retirement dollars and inheritance dollars that we will hand down to people one day. It's reckless with because the amount of money that we have determines how much we can tithe, how much we can give to missions, how much we can give to the needy, etc. So it goes much further than us. So we've got to be good stewards of that. So to me, that means don't buy reckless, crappy stocks. So anyway, enough said on EWW, but I hope you learned a lot on volume analysis. So GDX, you'll remember I said, with gold being such a good case, and there's such a great case for gold miners. The gold miner downtrend has clearly come to an end back here in 2016. So you had your A, B, C downtrend, which ended right here at 1220. Here's your short covering rally wave 1, and here's your A, B, C wave 2. So this is the bottom. This is the end of the likely end of the first dip of major dip, which is wave 2. When do people become the most pessimistic? Either towards the end of wave C or towards the ends or anytime in wave 2. And what do we see here? We see the selling volume increase up till this point, and then we see the selling volume decrease quite a bit. It picks back up a little bit, but then it starts dying back off again. So overall, still downward from this point. So you could even draw it this way to be accurate. So so your peak in selling volume happens here, which is in part of wave 2. It happens again, probably was what probably is the end of wave 2. And you have it building pretty high towards the end of wave C here. So those who are going to sell, I believe, between all these years from latter half of 2015 all the way through, I believe you already wrung out all your sellers of pretty much anybody who was going to sell gold or gold stocks have already done it. So the pessimists are out. When the sellers have been wrung out of the investment, then it makes it that much easier for the buyers to take back control. And so I believe that you probably have started that next leg higher with this being broken here. Now you will get a lot more confirmation of that when this horizontals in the 25s or so here, or 23 to 25s. Well, no, I think all these are at the 25. So in the 25s, 26s, once that's broken above, then so when this happens, when you get to about 25, 26, and it starts to sustain itself above that, then you're above these highs, and you're going on to higher highs. So wave 3 goes far higher than wave 1. Wave 3s tend to be some of the longer and stronger waves. Wave 3 or 5 will always be your longest and strongest waves within a 5-wave uptrend. And so we've got a long ways to go within this next move higher. And again, things are shaping up with RSI continues to trend higher, MACD continues to trend higher, selling volume dropping off. So just lots of good things I could say about GDX. So it's a great time to be defensive. It's a great time to be in gold. It's a great time to be in GDX. So GLD was our first position we ever put on in the LI portfolio, and we quickly some months later nabbed up GDX, and very glad that we did that. So LPL, LG Display Company, is one that had come down into what I originally thought would probably be more of a triangle, like a symmetrical triangle, has become a bit more of a descending triangle pattern over the last decade. And it's common for this stock to have swift dives and swift climbs, and swift dives and swift climbs. And so you need to watch the history of a stock so you can see its personality, its habit. And because when you see these things happen, then you know that it can happen again. And when you see these follow after that, because the stock is fundamentally sound, the recoveries do happen. And so when these are happening and you're in it, you have to just know and believe this is coming out of it, because good companies don't stay cheap forever. They return to a decent valuation, and they do that through PE expansion, which happens as the price rises relative to the earnings once again. So you've got the MACD breaking a downtrend line here and strengthening. You've got selling volume dropping off big time. You've got the RSI has been heading up some. You've got the latest leg of this downdraft here, this ABC corrective move here. has been broken here, bottomed here, and corrected here, pushed through the correction here. It's peaking through its 50-week moving average. It remains to be seen whether it will initially sustain itself above that, but we could be headed back to the 200-week moving average area, or we might have a little bit of a pullback before we head back there. Ultimately, it's got the ability to head on up to the top side of this descending triangle at a bare minimum, and eventually, of course, it's going to break out and head into a new overall trend. But with our averaging strategy, you really want your stock to go down on you after you first start owning it, so that you can average down on it and get all of your averagings in, and then it go up on you. I know it sounds crazy to newer investors, but you really do want that to happen. In other words, if we bought in the 13s and this goes to 15 and then heads lower, it's not near the return that you would get if you went in and bought in the 13s and whatever in the 10s, and then you bought in the 8s, and you still didn't catch bottom because it went to the 6s, but your average price, let's say, is in the 10s, and then it goes from the 10s to the 15s. What's almost almost 50% increase from your average break-even price, which here you were just a couple of bucks up on a $13 stock, not near the same percentage. So, buying at 13 and going straight to 15 feels better, but you actually get a bigger return if you start buying the stock at a fundamental value and a low PE, and it actually goes lower on you in price, which is even a lower PE typically, and you get your averagings down, and then it goes higher. And when this even happens too, like in this scenario, if you buy it here, it has to trend higher from the point at which you bought it for you to make money on it. When you do our averaging strategy and you buy at a value and it dips lower significantly, and you buy it at a value again and it dips lower significantly, and you buy at another value again, your midpoint brings your average price down so much so that this stock doesn't ever even have to trend higher again in order for you to make a sizable profit. This can go from the 6s back to your original entry point in the 13 area. And if it never went higher than that, I mean, if it dropped off the map even after that again, it wouldn't matter, because by the time that you get back to your original entry point in the 13s, between all of your three positions, you're in at about 10, and so you've gained $3 on a $10 stock, and so that's a decent 30%ish or so return on a stock that never even uptrended again, much less if it does, uptrend again in the future. So that's the power of averaging down, and so it'll make the difference between whether you have turbocharged returns or not. It'll make the difference between how long you are in an investment or not. For instance, let's just go back here in history. Let's say that this stock was a value right here, and so I bought it here. Now, if I went all in right here, what has to happen? I've got to ride it all through this downtrend. I've got to ride it through this sideways action here, and I've got to ride it through all the way back to here before I'm even back to break even. So I've got to ride through all of 2015 in this instance, and all of 2016, and into the first quarter of 2017 before I'm back to break even. I hadn't made any money yet. If I average down, so I bought here, and then I bought here, and then I bought here, and I still didn't catch bottom, which you never do, or almost never do. In other words, that can't be the goal because it's not consistently obtainable. But your average price is here. Then you have you rode through 2015 and half of 2016, and you're already at break even here. And then by the time it goes back to where the all-in person was back to break even there, you've gone from the 12s to the 15s, and so you're up several bucks on a $12 stock. So you're up like 25%, 25% when this person's back to zero. So you see how big a difference that averaging down can make. So I hope, I've taken a little time on that, but I hope that illustration really turns some light bulbs on for you. So BBBY is our next one that had, we let this get well into an ABC downtrend before we ever got into it. We let a ton of selling volume happen before we ever got into it. You can see that by all of this here. And so we let a lot of this play out before we ever got in. And no, we didn't catch the bottom, but again, we had our averagings. So most of you are up on your money, even with the stock technically being still in a long-term downtrend. And let me get rid of that. Until this breaks above that, we possibly are still in that. And again, I expect it to start breaking above that fairly soon. It's just a matter of if it does a pullback first and breaks above it, or if we just break above it. On the daily chart, BBBY shot up from the 10s to 17s, and I think could have some more still left to go, because even from this last base that it started, you've got a wave 1, 2, 3, 4, and so we probably have one more push higher on a fifth wave there, and that's counting micro waves. That's not any major moves, but that's just counting the small moves within a major wave. So we probably are going to have another push higher. The deal is, this really needs to, I don't know that this next push higher is going to get us to, the 2021 level, which is what I would like for it to be at before we take profits. So this could, this could push higher to some degree and then have a decent size pullback and then get us there, which is very, very likely. So we may be in this a little longer than we think, but just in case this first scenario pans out to where there's more short, because this stock has a ton of shorts in it even still. So there's a lot of shorts that had to cover here. And by the way, here was your point of maximum pessimism, and it bottomed just a couple of months later, and it's already far higher now than it was when everybody and their mama sold out back here in the 13s and 14s, and it's already been in the 16s and 17s just mere months later. So you see enough of these charts where there's unusual selling spikes, and you'll usually find that's where people are emotional, the sentiment's extremely negative, and they're making one of the worst decisions they could ever make. And what they'll do is they'll blame it on the market and the stock and their broker and their newsletter writer, like somebody like me or whatever. And it's their own thinking, and they have their own selves to blame. And all they see is, well, the stock is going to go down, so all it's going to do is keep going down. And the news coverage is bad. And I mean, you see this selling spike here, so I'm not on my own here. There's a ton of people doing what I'm doing. So again, they love the comfort and consensus of other people doing what they're doing, and then they feel a little bit even justified when it goes from the 12s to the 10s. They go, see there, I did the right thing. I should have sold out, and I wish I'd even sold out even sooner. And then all of a sudden the next big up move happens, and it goes from 10s to 17s. So what has happened isn't going to be necessarily a continuation of what will happen. And just because you feel a way a certain about a stock doesn't mean have jack squat to do with what it will do in the future. And people seemingly ask themselves too much, how do I feel about this stock? They're not literally asking themselves that question, but in essence they're asking themselves that question because they're obeying their feeling to that question. I feel bad about the stock. I feel bad about the decline. I've been in this a month or a year or two, and it's been down. I don't like it. I don't like the way I emotionally feel about it, so I need some emotional relief, so I'm going to sell. And it's the dumbest thing. It's the most immature thing that an investor could do. It's impatience. Maturity has patience. Immaturity doesn't have patience. Maturity is long-sighted. Immaturity is short-sighted. We know that in life, right? People who think long range, 5, 10, 15, 20 years down the road, they think retirement minded, all kinds of stuff. They're more mature than the people who live by the moment, right? Well, you've got the same type thinkers in investing. You got the people that if something hadn't turned around for them in a month or two or three or a year or two, even they think, oh gosh, I've got a bad stock, or Sean doesn't know what he's doing, or I never should have got into this, or whatever it is. And they don't give it time enough to prosper because they forget the manner of company that they bought. They forget how fundamentally solid it is. Um, they forget Elliott Ways, they forget stages and sentiment and pessimism, and they don't even realize they are the embodiment of the prevailing sentiment. They've gotten sucked into it like a vortex, rather than being the contrarian. When people are the most bearish, you should be starting to get the most bullish. When people are the most bullish, you should be starting to get the most bearish. That's how that works. That's why it's a small amount of people that make money and the masses don't. It's because everybody wants you to be non-emotional. Everybody wants you to have emotional control. Everybody wants you to be an independent thinker. And most people want consensus. They want to be doing what everybody's doing. And they listen to everything on the news media. And you have to understand that there are narratives that are created for you that they want you to understand. And they spoon feed you each day the narrative that they want you to believe. And if you believe and go by that as that's the gospel truth, as if it were the Bible or something, then you're going to be sadly mistaken, and you're either going to lose as an investor or you're going to greatly underperform as an investor. You cannot be an emotional investor and succeed. You cannot be a news-oriented investor and succeed. You can't be a irrational investor and succeed. And so there's a maturing of your mind and emotions that you have to have. There has to be a control over your own spirit and emotions and character development to where you put greed in check, fear in check, and you develop these disciplines over time, or at least follow and trust somebody who has, like me. I've been watching markets for over 25 years. And that's where you gain your edge in life. It's how you think and how you act, more so than what the stock is doing at the moment. It really is. The market's not against you. Market makers aren't against you. The market's not rigged. I'm not doing something against you. You don't have a broken system. It's all in how you treat, how you think, your self-talk, whether you go from being a logical investor, no matter how much I title something a logical investor and call it the logical investor, sometimes still my subscribers want to rename it to the emotional investor. So anyway, I hope that helps. So BBBY, very bullish on. Again, there was this narrative that there's a retail apocalypse, and I went through it in our monthly newsletter. And basically, Amazon's eating up everybody. Nobody's going to exist after Amazon. By the way, this is not the first time we've gotten the Amazon's eating up every retailer story. Remember when Best Buy was just a showroom for Amazon? Remember when the media fed you that narrative? And everybody started, and here's the problem. When there's a catchy narrative that gets a lot of attention, the other news networks borrow it and propagate it as well. And so when you turn on enough financial TV and enough people say to you, Amazon is eating up everybody, and Best Buy, the thought process was Best Buy has become a showroom for Amazon. In other words, people are going to just go into a Best Buy, look at what they want to buy, order it on Amazon, have it shipped to their door. And so people believed that. And so you had, Best Buy trend lower for a while on that. And then it started this big move from the 9s to the 80s. So was that narrative true? No, it was not true. If it were true, Best Buy wouldn't have gone from the 9s to 83, almost a tenfold return in a handful of years. And by the way, when this was going down, they never thought this would ever happen. So don't get caught up in, because this has happened, this will always happen. And don't get caught up on, because this has happened, that this will always happen, that it just goes to the moon. It will never reverse. You got to be conscious of when things are getting overvalued and undervalued, and that's where we should have PEs come into play, and the distance of how far the price is from its 200-week moving average, and when there's a great historical distance in that, We know that there's huge risks in that. So we know even up here that this stock is at a huge risk of sell-off, and lo and behold, it sells right back off to its 200-week moving average. So it goes from the 80s to 40s and cuts in half, and we could know about that risk ahead of time without watching it unfold and being a victim to it. Now, we're not in this stock. I'm just giving you an example of one of the original retail apocalypses that they talked about. So this has been rehashed more times than once. And then it's I believe this is probably a wave 5 on it, and this is probably a A, B, and then getting ready to go into a C on it. So again, this is not one you should go hop into. This is not a buy recommendation by any stretch. But the point is, is that the narrative was Best Buy has become a showroom for Amazon. And I went on Bloomberg TV and said that was junk, that Best Buy was still solid fundamentally, that Best Buy was undervalued, and that Best Buy, most likely turned around and it would head back higher. And that it did. So, and at the time, of course, to the actual, the onlooker, they think I'm smoking something because can I see that Best Buy's been going down for a while, and of course it seems natural that Amazon's just swallowing everybody up, and it's a believable narrative that's happening. But when I looked at Best Buy's earnings, that proved to me that people weren't just only buying at Amazon and not buying in the store of Best Buy. And when I looked at their cash and the size of the company, it told me that they were probably not headed for zero. They probably weren't headed for the dustbin. And they were starting to be such a fundamental value because they had been clobbered for so long. So it set them up for this nice, huge historical rally. So, and by the way, I also mentioned that if we'd have believed in the retail apocalypse, that we would have never gotten into, LB and made 18% in like 5 months or whatever on this ride up here. And now, it just had another earnings report and it's getting hit again, and we'll see if this stock goes to a new lower low and then bounces back again. Which again, we're not in this stock, even though there's a couple of you that are still in it, but most of us are out of it. If you saw the original recommendation, you're out of it. But if for any reason you missed that, then you may still be in. But this has enough fundamental strength to pull back around for any of those who still own it. But it's not any recommendation to anybody who's out of it. But we took advantage of this huge pessimism that was starting to die off, and we got the nice jump in it. Did an averaging or so, and it popped up, and we made our profit. But you wouldn't have dare gotten into this, if you believe the narrative of the retail apocalypse, and it's everybody's going to zero, and Amazon and Walmart's going to be the only things left. It's just not. It's a bit of a truth taken to an extreme, and which in the end makes it a lie. And I go into that in great detail in the latest newsletter. So, all right. So next on the list is we got CAJ. This one is doing much better overall lately. Again, I love it that this stock is not on a lot of people's radar. I love it that this has probably hit the bottom here. Here's your point of maximum pessimism, which corresponds to that right there. A couple months later, the real bottom actually happens. Selling volumes dropped off big time. Makes it much easier for the buyers to take back control. The price is above its 50-day moving average, and that moving average is rising. So it rose up a good bit and consolidated, bumped up a bit more. So I'm looking fairly soon for us to, take another stab at that 200-day moving average. And again, we might go down a bit more before we head up there. And you usually won't overcome that 200-day moving average the first time it hits it, and sometimes it can take multiple attempts. But on a future attempt, it eventually breaks out of that and heads much higher. So I'm looking for that kind of a move to happen over time. The RSI has been heading higher, selling volume dropping off, MACD heading higher. So again, showing strength and bullishness coming into this stock. And so I'm just very impressed with where that's at and how it's going. and that one's looking pretty good fairly early on in the investment. Remember, we hold stocks generally for 2 to 4 years on average. We have had some that have happened for us in a very short amount of time, but just because our first several sales have happened that way, do not set that up as your expectation, because that is not the case. That's not how investing normally works. We just happen to have some that worked out on the short end. Just like we will probably have some that are a little longer than our 2 to 4 year holding period. They might go into a fifth or sixth year, whereas most of them will fall in that 2 to 4 year period. But in those times where you're holding 1 or 2 for 5 or 6 years, remember that when we started the service, you just had 4 stocks cash out in 6 months or less, something like that. So that were way lower than the average holding time. So it all works itself out over time. Some you'll hold shorter amounts of time, some you'll hold longer amounts of time, because only you can determine your entry price, and the market determines how quickly you get your profit. We got into one stock at a fundamental value, and it zipped up and hit its profit in like 3 weeks. That's ridiculous. Probably never happened again. Never expect that to happen again. I mean, I'm thrilled if it does happen again, but don't expect for it to happen again, because that's not normal. So the market in that case got our profit very quickly. But then there's sometimes where you will buy a company and it's the same fundamental quality, same fundamental value and discount, and it might take the 4 years for it to come back around. It's how quickly market participants, particularly institutions, realize the value and come in and bid up that value and take that from a discounted value back to a fairer value, is when you are able to reap your profit. And only the market determines that. But the reason why I know that, by the way that we hone our investing, if you go to your broker and you say, I want to invest money in stocks, if they're a good broker, they're going to tell you not to invest money in stocks that you can't leave there for at least 5 to 10 years. And why is that? Because they know that market cycles are long, and that most people are horrible market timers, and they don't know how to invest in stocks. And so they just invest money regularly at the 20th of each month, or when they get their each paycheck, or annually once a year they make a contribution or whatever. They've got all these different ways that they buy, and they know that it's going to take a long period of time for most of them to turn a profit. Well, because I have a fundamental, technical, and sentiment system that analyzes first from a fundamental standpoint, and then looks for things to help better time things from a sentiment and technical analysis standpoint, which are slight honings and give slight edges over and above the fundamentals after the fundamental boxes have been checked. That all collectively teaches and shows me something about it that shrinks that average time frame from 5 to 10 years down to 2 to 4 years on average, with a few stocks being less than that average, and a few stocks that will likely be longer than that average of 2 to 4 years, and with the bell curve of 60 to 80% of the stocks probably falling in that 2 to 4 year average time frame. So just realize that really is true investing. Anything else below that really is speculation. Why do stocks go up in the first place and sustain those gains? Because you got real companies that make real products or deliver real services or some combination thereof. And it takes them time, time, to expand markets, to expand territories, to sell more products, to deliver more services in more cities, more states, more countries, and that takes time. And as that happens over time, their earnings increase over time, which justifies a higher stock price over time. So that's why true investing does take time. There's just no ways around it. The Bible even talks about avoiding get-rich-quick schemes and quick wealth and things like that, and that money comes and wealth is built here a little, there a little. And so it's even biblical to have that view. And it amazes me how many Christians want quick riches, and I think to myself, they don't even know what the Bible has to say about money, because the Bible tells them not to seek quick riches. That's why I don't worry about the lottery and stuff like that. So anyway, IBM. This one, had a quick dive off here. And of course, you have everybody and their mama come out of the woodworks. Oh, IBM's has been done for, old tech, behind the times, never coming back, blah, blah, blah. And of course, you get one spike of negative pessimism here, quite a cluster of it right in here. And then probably what's your real bottom happening a couple of months after this spike here with your selling volume dropping off quite a bit, and your buy spike, by the way, getting big time, which jacked this up. This is probably some short covering as well. So now IBM has come from the 104s to 140s in a very short amount of time, a couple of months or so. So just know that it would not be unusual at all for IBM to come back a good bit before heading higher. No, that is normal market mechanics. I mean, this stock didn't even trade anywhere in this gap right here. It gapped up from the 120s to 130s. So just know that it would not be unusual at all for this to, one, come back closer to its 50-day moving average, where it's a little above it, at it, or overshooting it some before heading higher. It's common, it's not required, but common for stocks to close their gaps, meaning to call it to fill a gap, which means for this to come back and overlap at least half or completely close a gap. So anywhere from here to here would not be unusual for it to pull back before heading higher. So just know, while it doesn't have to do that, it is likely to do that. And if it did that, well, that would be normal market mechanics. Could it just pull back to something low and head higher? Sure, it can do that. But this stock, because we got into it at 146.10, and because you've had averagings down that have gone all the way from the 140s to 104s, by the time that we just get back to your original entry price, you're already up a good bit on it, much less if it goes higher. So again, it doesn't even have, we expect our stocks bought at fundamental values to trend higher over time. But with our averaging strategy, we don't even have to get back to a higher and new uptrend of higher highs overall from our average buy point for us to make from our starting buy point, rather, for us to make money on the investment. That is such a beautiful thing. I mean, it's learning how to structure your investments with 3 equal dollar weighted batches is so much more important to get, and rather than just planting a flag and throwing all your money that you got at IBM in at one price point. Do not do that. It's one of the most important things I could emphasize to you. It's just as important as fundamentals, technicals, and sentiment. So once you know that you've got a strong fundamental company at a cheap fundamental price, and then you hone it by trying to buy with some extra negative pessimism or a better technical signal or whatever in addition to that fundamental value point, and buy there, you also want to have that averaging is your icing on the cake. It's the turbocharging of your investments that'll have you in your investments less time in many cases, but certainly with larger percentage returns. And that's even been proven out on our site as you hear the investors on this site tell their returns. One will get 15%, another will get 30%, and they were in the investment at the same time. But what happened was one of them took advantage of the averaging down points like I taught, and the other one didn't do it. And so, it makes a huge difference in your percentage returns over time. So imagine if, we get in and out of a stock, and this time, our return is 10%, but yours is 5%. And another time it's, we get out at 20 and yours is 10, and so forth. What that margin of difference is, extrapolated over even just a couple of years, much less 5 or 10 years, the difference in the account balance sizes and percentage gains over time as that compounds, what that adds up to. So really, really, really get it in your head how important averaging down strategically and having those very wide balanced averaging buy-in points is so key and so crucial to your long-term success. It is just as crucial as any part of the rest of the system. So don't deviate from the system. Don't try to change the system. Don't try to tweak the system. Don't try to improve upon it. Um, just follow it, and it has worked very well over time. And it's not a gimmick. It's a tried and true thing that I've done for many years. So KHC. So if you just listen to the shock jocks on TV, again, financial TV, they're reporters. They need ratings. They need eyeballs to sell advertising to. So they need shock value, and headlines give that bigger than anything. And fear-based headlines and shocker headlines get the most eyeballs and the most ad revenue. So that's how that works. So when you see a news headline that says Warren Buffett says he was wrong on Kraft Heinz and he made a mistake with Kraft Heinz, well, you have to realize that Warren Buffett and 3G own something like 50 or 60% of these two massive companies, and they paid something like $100 billion or something for it. So what he's saying is for what he bought for two individual businesses, he on his stuff feels like he overpaid, which has nothing to do with what we bought at the levels that we bought. And again, it is totally different. And even he says in his interview that Kraft Heinz is still a fine company. He's comfortable holding the company for the next 5 to 10 years. But do you think that made the headlines? No, it didn't, because that's not near as juicy as them isolating something. Warren Buffett got it wrong. Warren Buffett made a mistake. Warren Buffett lost. The one they like to throw out there a lot too is Warren Buffett lost X amount of billions of dollars on this stock today. Here's the deal. Warren Buffett's portfolio is so big that on any given short period, a day, a week, any kind of short time span like that, his portfolio overall can vacillate up or down $2 to $4 billion in anywhere from a day to a week, because his portfolio is so big. That's such a small percentage of his account. But it's a juicy headline to hear Warren Buffett lost $4 billion today or whatever it is. But if Warren Buffett was losing all these billions all the time, like they say that he is, then how is he the Oracle of Omaha? How has he increased shareholder value through the years? How's he beat the S&P 500 through the years? He didn't do it by losing money all the time. That's for sure. So you get painted a half-truth. You get painted isolated comments, and then everybody and their mama builds a story around the juicy stuff. So if you're just a headline reader, or if you just read what the media spoon feeds to you, you're going to be misled. So that's why in the newsletter I posted the full interview with Buffett, which is a lot more balanced, and you'll hear the comments where he says, "I'm fine with holding Kraft Heinz for the next 5 to 10 years. It's still a good and wonderful company." Yes, it does have too much debt. That is a long-term problem that if they don't fix in the long term will hurt them, and I believe that they will fix that. But that's a problem that they will have much further than the time horizon for which we will likely end up owning the stock. So also, we've, of course, employed an averaging down strategy to where, just for round numbers sake, we got in at 55-ish, and I think the next one was like technically 44-ish, but just call it 44, 45-ish, and then the next one was like 35-ish. And so the average break-even point's around 44, 45-ish for most of you. Now, some of you missed out on this little bump up here, and so some of you, your second one's here, and your third one can be even lower. But so everybody will be at a little bit different place for this, depending on where you caught stuff and where you particular average down. But overall, it'll be back here. So Kraft Heinz never has to uptrend again for us to make money on this stock. This stock, it could go down even quite a bit lower, and then just come back to its declining 200-day moving average, um, right in here, and the price from 44, 45 up to 53 would be our break even point. And so you've got what is that? 8 points on a $44 stock. That's a good percentage gain, return over whatever time period that takes. Now this turnaround, now I'm drawing it V-shaped and angled up high here because that's all the room I've got on the chart. But this could take months. This could take a year. This could take 2 years. It could take 3 years, and we don't know what time frame the market will bring this in, because markets can do this, which they rarely do, V-shaped moves. They can do this, which are U-shaped moves, which take longer. They can have a meandering decline that's at a long, just a death by 1,000 cuts fall, and then move up, which can be even longer in time. So there's all kinds of different bottoms that can happen. These types of bottoms are more common than V bottoms. U bottoms and ones that do like this are a lot more common. So it takes time, and that's why when you are buying into a stock, you don't want to buy any stock that you are not comfortable with holding at least 2 to 4 years in that stock. And even if you're in retirement, it doesn't mean just because you're in retirement you can't invest for that kind of time horizon. It just means for the money that you'll need that's in that particular investment needs to not be needed before, say, a 4-year time horizon, and because it will likely fall somewhere within the 2 to 4 year time horizon, with some of them being a little shorter than that. So we don't know, if this zips back up within months, or if this takes a year or 2 years or 3 years. But I'm quite confident that it makes this turn. I do know in the near term we're deeply oversold. We've got selling volume galore, about 130 million shares net sold in a day, of something like a third of its float. So massive negative pessimism, and the stock punished a lot in a very short amount of time. Another thing that I would note on this that I commented on the site, I believe it was just in one of the general commentaries on the site, in some of the day-to-day commentary, but I said if you put Bollinger Bands on it, the stock had traded 4 days outside of its bottom Bollinger Band, which is very rare. I mean, like even when stocks decline severely, they usually just kind of hug that bottom band on the way down. Even though the stock's still falling, it's still falling within it. And very rarely do you get a spike or a little day or two or something, that's out of it. And this one has spent 4 days out of it, which showed extreme drop, extreme pessimism on the daily chart, and then also on the weekly chart, it had dropped so fast as well that when you put on the Bollinger Bands on the weekly, and it's probably not as easy to see in this, but it had dropped out of the bottom of the weekly band as well. And when you look historically, like there's a little blip there and a little blip there, just a hair there, just a hair there. So there's like 3, 4, 5 times over the course of close to a decade where that's happened. So it's extremely rare. And then when you couple it being very far away from its 50-week and 200-week moving averages, it would not take much for this to have a snapback to the 53 to 55 areas. And when it does, we can take our profits, because we've when we've averaged down, when it gets back to even our first original entry point, we've made so much money on it overall, because our average break even point is our midpoint, that we've done very well on it. By the time it does that. So And you just have to realize a lot of people that are in the stock have bought this way too high. You know, they bought it in the 80s and 90s and 70s and stuff like that. And so it's going to take a very long time for them to see those heights again for sure. And again, somebody could have known that Kraft Heinz was in a ridiculous state of overvaluation, even without knowing fundamentals, just because of watching the chart. So, for instance, when it came back public, it was at this kind of a trajectory, and then all of a sudden it goes to this kind of a trajectory. Well, this steep of an angle is not sustainable forever. It can be sustainable for a long time. I mean, it happened here for a couple of years or something like that. But eventually, these super steep angles also have super steep angles to the downside as well. They look like upside down V patterns. So these bubbles, when you get out of a normal overall ascent into something that is way too far too fast and unsustainable, and the price gets way away from the 200-week moving average, it shows that anytime that is the case, anytime, doesn't matter what the asset is, whether it's ETF, stock, doesn't matter what kind of stock, doesn't matter what sector it's in, anytime there's that kind of a discrepancy between where the price is and where its 200-week moving average is, you know there is a potential, huge potential for downside risk. And when it's gotten this far away from it, it doesn't usually just stop at the 200-week moving average. It usually goes far below that. Now, sometimes it'll just be some below it. Sometimes it'll be extremely below it. But you know that there's potential for huge risk. So if you just know that this has risks of going from the 80s and 90s down to the 50s and 60s, then you know that you have huge risk if you're in here. Yet when all this is happening, Kraft Heinz can do no wrong. The news media coverage is it couldn't get any better. But but you get extreme reading on your RSI. The distance here between the moving averages is huge. You get your MACD that had been declining for years, showing loss of upward momentum was coming, and here's your reversal. The funny part is the media now makes a big deal about its debt, and it's got the same amount of debt here that it had back in here. So wasn't no problem with the debt back in here when people were willing to pay $70, $75, $80, $85 a share for it. Now all of a sudden there's a problem, when the stock is down here. So again, there's just all kinds of funny, biases that are out there and narratives that are out there, and you just have to learn that you're just spoon-fed a lot of stuff. It takes a long time to put all the two and twos together and read between the lines, and I've been doing this a long time, so I know from being on the inside of Wall Street brokerage firms, from having professional investors that have traded on floors of exchanges, to just my own experience over 20 something years. Between all of it, you just learn a lot of stuff of Wall Street habits, Wall Street biases, things that are against you, the way that just there's all kinds of things from the media that will trip you up, things from Wall Street and analysts and upgrades and downgrades and TV commentary opinions and all kinds of stuff that's really just gets you on the fear side, the emotional side, and trips you up more so than anything. And on the upside, it keeps you in the greed side and holding on to stocks far longer than you should as well. What do you think? This is ENI that we're on now. What do you think the news coverage is right in here? It's wonderful. ENI is hitting on all cylinders, can do no wrong. Oh my gosh, it's going to the moon. And then it goes from 40s to 20s, cuts in half in a couple of short years thereafter. By the way, when this was happening, they never thought this would happen. And when this happened, they never thought this would happen. Go from the 20s to back to 39s, 21 to 39. So what has happened has nothing to do with what will happen. You need to learn that and get that solidified within you. And when the price of any solid asset is way above its 200-week moving average, it still carries huge risk, even if it's fundamentally sound and fundamentally cheap. And when it gets way far below its 200-week moving average, as long as it's fundamentally sound and fundamentally cheap, it is likely going to snap back to that moving average and then some. So just, learn some of these things along the way, and I believe that they will help you a lot. I mean, what you're getting is seriously a very professional level type of advice and opinion, but hopefully taught on a way that just anybody can understand it. So just know in the near term, ENI, which is ticker symbol E, is bumping up against a 200-day moving average, which is not inclining yet, and almost never does the price go above the moving average the first time it hits it and sustain it. And when I say that, I'm not saying that it can't creep above it just temporarily before having a pullback. And sometimes it doesn't creep above it at all, and it just does its pullback. But I am expecting for it to eventually break above that 200-day moving average and head back closer to these old highs here in the 38s, 39s, and we bought in the 33s, and some of you have even bought it in the 29s and 30s as well as it pulled back. So everybody was in love with oil and oil stocks here. Nobody was in love with oil and oil stocks just months later when they got slammed from and cut in, well, not cut in half, but from 39 to 29s. And point of maximum pessimism here. And then you've got the selling volume dropping off big time, buying volume starting to pick up. Your MACD downtrend gets broken and starts to head higher through here. Your RSI starts to pick up steam here and strengthen as well. So I'm looking for some sort of pullback because the price is too far away from the 50-day moving average, and it's getting ready to right in the area where it would bump its head in the region of the 200-day moving average. So I'm looking for it to come back some. It could come back a little. It could come back a pretty good bit. Whatever, anything like that's possible. I mean, it could even come back, steeper. Occasionally, but not often, you have corrections come all the way back to the point of their exact bottom and then go up and continue their whole new uptrend. I doubt that happens, but it could it could happen. So any kind of combination like this could happen, and then I expect it to head higher from there. So again, very bullish on ENI, and again, the value comes when the sentiment's bad, after stocks have tanked a lot, but yet are still fundamentally solid. And that's why we had no interest in buying here. Plenty of my subscribers, hey, aren't you interested in oil stocks? Oil's going up. Oil stocks are going up. No, I don't have any interest in, because everybody and their mama's onto that, and everybody and their mama loves it. And there's no value to be had there. But then it takes a slam, boom, over 60 to 90 days, goes from 39 to 29. Yeah, I'm interested. The sentiment's very, very bad. And and now there is likely value because the sentiment was negative, and everybody wasn't so certain on oil once again, and the pendulum finally shifted back into our favor. And normally it doesn't happen over that short of a period of time, a couple of 2 or 3 months, but it did in this case. And so I went from periods where people were asking me on the site about, hey, am I interested in oil and more oil stocks? And I said no, to all of a sudden, boom, now I'm interested again. So that's why it wasn't a being fickle, or it was the market had a new paradigm. They were bullish on oil, now they're bearish on oil. Bullish on oil stocks, now they're bearish on oil stocks. Well, when they're super bullish, I'm not. When they're super bearish, I'm starting to get bullish. And as long as the fundamentals and the PEs back that up, then that's a starting point for me. And then if I can, see some technicals that are in my favor and some sentiment that's in my favor, then that's even better. So anyway, that's it for this week. Went a little long, but I believe there was some great concepts taught in here that I just don't believe you're going to find most places out there. I just don't believe most financial newsletters go into this kind of depth, teach you this kind of institutional level thinking. That many of them will give you recommendations and say buy this, sell this, but they won't teach you the concepts, the strategies, and the whys of it near as much and in depth as I go into. And it's just as important for me to teach you the whys of what we're doing than just what we're doing. So anyway, pray this has been a blessing to you. Thank you so much for watching this. Help spread the word about what we do. Pray for the success of what we do. Pray for me regularly if you would. I appreciate that. I always appreciate you doing that for those of you who are believers. And God bless. Bye bye.